Well, hello everybody, and welcome back to another Pepperstone live stream event. This one is a special one because it's US earnings season coming up. My name's Thomas Atkinson. As always, I'm joined by Tyrone and Abela. And Ty, I'm pretty excited for this earnings season, but also a little scared. How are you feeling?
Yeah, welcome everyone. Yeah, look, it is a little bit of an interesting one, isn't it? Like, it's probably going to be the first earnings season that is coming in at a time when I think the all of the panic in the market is basically already there. We know that we've already got the inflationary talks, interest rates are going up. This is going to be the first real test, I think. And I think the next month or so of trading is going to be very, very interesting, both internationally and from a domestic standpoint as well. I think we're going to have a very interesting 4 to 6 week period, that's for sure.
Yeah, absolutely. I think it's going to be a massive kind of news announcement session. I mean, not only does everybody need to be aware that today we have the CPI headline inflation, but we've also then got other news coming out. Thursday, we have before market news, and then we have core retail sales on Friday. All that's kicking off at the same time, Ty, as we have the big options expiration happening this Friday. And then on top of that, next week begins earnings. So it doesn't get much bigger than this. This is what most people out there have been dreading from the perspective of they're a little bit scared because of the bad news. There's a lot of people that are very negative on the markets right now, Ty, but I've seen that markets can do what seems like irrational things during these types of periods. So let's talk firstly about what we're going to be covering today, and then we'll get into some chart analysis. We'll obviously go through the economic calendar and also mitigating risk, how you can potentially do that. So yeah, how US earnings impacts are going to impact this market, how the charts and calendar analysis looks, and of course, live Q&A. So if you have any questions, feel free to ask them. I think one of the biggest things you'll get out of today is really how we approach markets over this time. And that's really important. You have to have a calm, cool head and say, okay, let's think of scenarios on how the markets could move coming out of these announcements, because it might do something completely opposite to what you think. How are you going to react to that? Are you going to sit on the sidelines, possibly a good scenario, or are you going to take action? Today, we'll hopefully be answering some of those questions. DJ AJ coming in, he says, earnings season sucks. Yeah, sometimes for traders it does, but remember, it does also increase volatility, which can be helpful, especially if you're an index trader, which many people out there are. So make sure you're aware of earnings. We'll use a website such as Earnings Whispers. No, we're not affiliated with them, but the thing is that this particular one often has these great little feature kind of charts each week, Ty. I really like this. I think it's helpful for all traders out there to know the big kind of weeks. Now, if you get ones like this, where you've got usually what we call the big tech week, usually there's the big bank week and then the big tech week. They happen in the first couple of weeks of the earnings season. These are the ones you got to watch out for. I mean, here during April of 21, you had Tesla, AMD, Apple, Facebook, Amazon. This is a considerable percentage of the NASDAQ, considerable percentage of really the entire market. These are the types of things that you have to be aware of. Has anyone here in the chat, I'll ask the chat right now, have you ever been caught where you've been in a stock and you didn't know earnings was coming out? Ty, I'm going to put my hand up just slowly a little bit. I've done it once before, a very long time ago. Never again.
Yeah. Because I think I'm probably guilty of that. You definitely get guilty of it. Oh, yeah. Of course. Yeah. I think that you would have to be an amazingly disciplined trader that would not check for news every single time you traded, especially when you first start out. It's the last thing you're probably thinking about, really. So it would be amazing if anybody out there didn't actually get caught out at some point. And getting caught out doesn't mean that you actually lost on the trade either, by the way. Sometimes you can actually fluke it and say, yeah, how good am I? and then you realize that, they had a record earnings, and they're like, oh, yeah, I knew that. Yeah. We've been on both ends, Thomas and I. Don't worry about that. Yep. We've been on both ends of that early on in the piece. So you've got to be really mindful that you don't want to be guessing and checking that. This is something that you really need to be aware of. Just like an interest rate decision for a currency trade, you need to be aware of when that's happening. Earnings is just as important.
So Ty, some of the things that I thought I'd bring up here is obviously we look at earnings, and many people will look at it from the perspective of, well, I'm trading a particular stock, let's say Tesla, and I need to be scared or happy potentially around the earnings around that stock. Well, that's one way to do it, but often there is kind of like a beats and misses, and these become important if the general consensus across, let's say, a sector in the market, let's say it's financials, because we'll look at that soon, was beats. and everybody thought that the banks were doing well, then you expect that financial sector and the banks across the board to start to improve. Now, the other thing that you can be looking at is, of course, the indices. Now, some people like to trade the ASX 200 and S&P 500 to eliminate some of the overnight risks between earning seasons, because a lot of the time, Ty, when do these earnings come out? Before market or after market, don't they? And a lot of traders get caught with that one as well.
Yeah, 100%. It's really, really important to remember that, you know, a lot of the time, if you are trading the open market, you're not going to have any control over closing a position out, because these things will happen when the market's not open if you're trading the absolute stock. So you've got to be very, very mindful of that. Earnings don't generally come out in the middle of a trading session.
No, not very often, not for the big ones. No. So what's the most important coming into this earnings? And we'll look at it soon. S&P 500, we will look at the chart. That remains the most important overall technical chart to study and understand. Whether you're really in Australia, you're in Europe, or you're joining us from anywhere else in the world, or the US, obviously, these are the most important charts. And this is basically the big one, because what the S&P 500 does, it tends to spill over into the other markets. And what we're seeing in this current market is a very strong US dollar, a relatively strong S&P 500 compared to some other world markets at the moment. And obviously, if we see weakness in these earnings and S&P 500 starts getting downgraded and people start to get fearful, then all of a sudden it can create a bit of a trickle effect. So understanding the technical analysis, I'm eagle-eyed, Ty, at the moment on the S&P 500. We'll come back on the screen. Yep. We're eagle-eyed. I'm absolutely razor focused on this one.
Yeah, I've got my Arlo cameras at every angle looking at the S&P 500 at the moment, because you kind of have to, because at the end of the day, like it or lump it, they're the leaders of the world, and what happens there influences every world market. There's no question about that. So really, you've got to get the information from the source. And you know what, our earnings season in Australia obviously, you know, goes after the US Open. Like we're not doing it at the same time. Like we don't really start reporting until around sort of August-ish. So we're a few weeks behind. So, and I think that probably highlights what we're saying, Tom, really, that you've got to be able to, be prepared to be able to trade an earnings season, because it's not just a 2-week period over a year. Earnings seasons happen twice, by the way, and they generally follow on from each other. So you got the US, basically doing their earnings, and then we follow on by that. So you've got about a month to 6 weeks worth of earnings results. So and that's twice a year. So you're talking about 20% of the year that there's earnings of some description that will affect us in Australia, and of course with the US earnings. So it's something that you can't just ignore.
No, absolutely not. And you know what tends to happen actually in markets is July tends to be a very strong seasonal period. Now, we're not necessarily in the year of seasonals, being the high VIX, being the uncertainty, the probable recession that we're in already based on some stats. 1.6% here for July in terms of what the average return is over the US stock market for a very long period of time. You'll notice it's actually usually the best month. Now, I think a lot of that's a lead into the earnings, and then the earnings actually living up to expectations. This year, of course, could be different, but it's interesting just to look at the stats over time. And when you understand some months are better than others, often when markets come back to normalization, you can really see markets ramping in to a lot of the earnings seasons, and they ramp into these earnings seasons. And then often they kind of overshoot. What I call it, Ty, is kind of that buy the rumor, sell the fact. We're not in this current market, but usually what you see is a stock will often go up into the earnings, and a lot of retail traders, we ignore what it's done. A classic case of this would be to go and look at steel and energy stocks coming into earnings this time around, the previous earnings. We had effectively huge gains on the stocks, somewhere upwards of 60 to 80%, and they just couldn't back it up with real figures. And of course, they dropped off. So this time around is a little bit different to normal. Usually we have some kind of trend leading into it. I would say the trend at the moment obviously has been down, but really since probably around May, if you actually take the S&P 500, and I think we'll jump into the charts right now, it hasn't done that much. So it's gone up and down and all around, but it's actually been sitting. So here's the June, May kind of period. We bottom in here in May, and we're actually at the same point. While it's been wild both ways, don't get us wrong. If you were taking those 2 months out, you've kind of got a middling point here now, Ty, between both. So heading into this earnings season, it's like a equilibrium in the market in some ways. I'm sure you could probably put maybe some kind of 2 month. Let's have a look at a 3 month here. Not quite a 3 month, but I'm sure like a 2 month or a 1 month, you're kind of getting almost an equilibrium point at these areas. And what does that tell us, Ty? We don't have necessarily a price action direction. The market is itself confused about this earnings season.
As it should be, because no one really knows what the hell's going on. And if we, like that speaks for most analysts. If they tell you they know what's going on, they're lying. So really, all we're doing is speculating, because the truth is, this is a very, very important earnings season, given what's happening around just the raw numbers, right? We know that. And look, the reason why a lot of people do ask us, why is earnings season? Why does it ramp up? Prior to, well, a lot of that has to do with how people trade and whether they're actually anticipating dividends from the stocks that they're trading, whether they're anticipating franking credits in the Australian markets. All those things definitely lead to markets maybe rising more than they, and sometimes overshooting, like Thomas said. Now, we always talk about the sell in May and go away. Funny enough, May is after that earnings period, that very important earnings period, through the February-March period. September. I mean, if you want to sell in May, what about September? I mean, geez, that's the one that
September
really,
in the US.
September in the US is a nightmare. I mean, it's sell in September and drink till you can't remember, because it's the one that really drops, and it's straight after the earnings season. So when we say it overshoots, quite often that happens, and then the pullback is probably a little bit overshot as well. And I think you've got to be prepared for that and understand that does happen, and it's not just an occurrence that's it happens more than you think, and the stats actually indicate that. So it's good to know and understand that.
Now, I've labeled this a little bit more advanced, Ty, because I want to talk about the bullwhip effect. And this is something that's playing out and why the markets are confused right now in some ways. And it'll make more sense when we think about it very, very soon. We're going to talk about yields and the way that yields work from the Federal Reserve, because most people will need to understand this play in the markets right now of how yields are working ahead of these earnings. So the bullwhip effect is basically a concept where, on the demand side, a small change in demand has dramatic ramifications to the entire network of course, demand, manufacturers, supplies, and everything. Now, most of you are probably aware, of course, if demand increases, what happens? Then we often have shocks. We have, of course, what we've got right now, which is inflation, increasing prices, all those types of things. But the bullwhip effect is a simple kind of concept. Let's say there was a grocery store that sold 1,000 cans of tuna a week, Tyrone. And then all of a sudden they started getting demand, and the demand was going up and up and up and up and up. And all of a sudden they said, well, maybe we need to order 2,000 tuna cans. And everywhere else this was happening. But it turned out that was just a blip, funnily enough, caused by a huge amount of money being printed in the market and, of course, everybody getting stimulus checks. So that blip happens, and then all of a sudden that demand suddenly starts to drop. That's effectively what the Federal Reserve has done by raising rates. Who is left holding the bag? Is it the consumer who's been purchasing the cans and they've been eating them and pretty happy with themselves? Well, they purchased, they've got more sitting at home. But what ends up happening is, because they've then got these tunas, they're already ready to go, is it starts backing up in the supply chain. And who's left holding the bag? This is where the whip comes in. Usually the suppliers. The suppliers have incredible inventories, and those inventories are just rising and rising and rising. And it's a big problem in economies. And that's where we currently have this effective stream, Tyrone. We're sitting here and we're starting to see suppliers holding massive extra surpluses in stock, which is doing real harm to their share price. And of course, that's part of the reason why some sectors are down so much.
Yeah, and look, luckily tuna is non-perishable, so they're going to be okay in the long run. But let's put it to an example. Look, if you want to really bring it to a real life example, and I think it's probably that. Why not? Look, we've got I'm sure all of you are aware that there's a building crisis happening, probably around the world, but especially here in Australia. Basically builders can't get timber, can't get steel to actually finish the jobs that they're currently working on. They just can't get it. Now, at some point, and this is what Tom's saying, at some point, the supply and demand is going to equal out. And then the timber suppliers who are basically buying the extra 2,000 lots of timber because they think the demand is there, are going to be left holding extraordinary amounts of inventory because building is drying up. And amazingly, even though people can't get timber to build houses, builders are going broke every week because of the very reason. These builders aren't going to come back. Like, we're going to have a shortage of builders. We're going to have a shortage of building. And the suppliers are going to be left holding the bag. Exactly what Thomas is saying. That's just to bring it to to a situation that's actually happening, right here and right now. And that's only one industry, right? Like, this is happening across many, many industries. So you've got to be mindful of that, and you don't have to actually fully understand it, but you have to be aware of it. And I think that's probably the important part, because then when you start looking at sectors, you need to have that big, overarching view of what's actually really happening, and what are the potential dangers for these sectors.
Well, the point is, Ty, they don't necessarily, we're so used to in these markets V-shaped recoveries. So that is a market where it comes down really quickly and then goes up really quickly. In certain sectors in the market that are stuck with these supplies, they may not go up as quickly as people expect. MZC here with a great comment, Peton, which is a bike company, warehouses full of bikes everywhere. That's true. And I think now they're outsourcing. I don't know what they're doing, but there's all sorts of problems with those companies. So this bullwhip effect is real, and it has dramatic ramifications on everything around us right now. In some ways, I'll zoom this chart in. You can see what's currently happening in these markets. We're on this is like a simplification of the economies around the world. You can see here when interest rate paths are going higher and we have a weaker economy, often people move into dollars and VIX style trades. Obviously, during different periods, there's a great chart simplifying the economy, but during different periods, things have done well. So we've moved out of a stronger economy and we're starting to move into a weaker economy. And of course, that's why these US dollars are potentially going up. But the reason I brought all of this together, Ty, is to talk yields. So I want to just quickly here talk yields, because coming into this earnings, I think we all need to be aware of what's going on. So by December of this year, it's expected that the Federal Reserve will be at 3.34%. Now, a lot of people, funnily enough, still don't know that's actually the case. They don't understand that the Federal Reserve at this current rate is going to have a federal funds rate at 3.34%. And it won't end there. Remember, this is not necessarily the end as what the current market's telling us. To beat inflation, they're going to have to go higher. By April of 2023, it's expected that the rate's going to go to 3.4%. By September of 2023, it's expected that the rate will actually fall and go back to 3.125%. So what that's telling us is the Federal Reserve is trying to combat inflation. And this is the big concern coming to earnings for certain sectors, and that's why we're bringing it up, is that they're going to try to combat inflation by spiking the rate, and then they're going to have to probably curve that interest rate to try and support the economy. And this is because so many of these businesses will be holding inventory, will be holding potentially debt, and they'll be, of course, unfortunately, firing staff, which we're already seeing in the tech sector, usually a prelude to what happens in the other sectors. So this interest rate change is going to be drastic and a big thing. And I think a lot of people still don't even expect interest rates to get to these levels. This is what the market's saying. It's not our opinion. It's got nothing to do with our opinion. It's just what the market's telling us the rates will be in the future. And you'll see by the time we get into 2024, which is obviously very far off, the rate's back down to 2.7. So what the market's telling you, and this will change all the time, is it goes up really high and then it goes back down. And I think that's going to affect certain businesses that are holding these types of inventories tight. And it's just something to think about coming into this earnings season.
Yeah, most definitely. And look, don't think for a second that, we're all doom and gloom and thinking, oh, wow, this is going to be horrible. All we're saying is that you need to be aware of it so you can treat it as a trading opportunity and also help it enhance the trades that you're placing. Now, look, as an example, right? If you're a scalper, let's just pretend that you're a scalper, and you can scalp the index. You can scalp the S&P 500 on a ticker chart if you want to. Is that going to be affected by earnings on an hourly level? No, not really, right? So you've got to look at it from a bit of a standpoint that, are you an investor? If you're an investor, then earnings is an important part of what you do. But probably, it's going to help you probably more than it's going to hinder you, because in the end, earnings seasons generally push the market up at some point. But if you're a swing trader that's relying on trades being in the markets for, days and weeks at a time, then it's something that you really, really have to be conscious of. If you're trading on a minute chart and you're in and out every 10 minutes, it's not going to be as influential to your decision making. But if you're a swing trader and your trades stay in for days and weeks at a time, it's extraordinarily important to understand what's happening at this time, because it really can influence what, how you place your trades, but more importantly, how you manage your risk.
So here we go back into the US 500 here. And as Tyrone mentions, we're coming into, we're talking about a very long-term kind of concept there, but it's something that we still want to be aware of, because some people are picking sectors, Tyler. It's like kind of the travel sector. Ask yourself the question, since this whole COVID thing happened, did the travel sector ever truly recover? It's a question that then you ask about right now. When would something like, let's say, a Piton recover, or something that's holding high inventories? You're going to need demand to come back in general terms. It's something that's just important just to click that finger and say, okay, I see this. Maybe the risk is too great. Maybe I need to now go and have a look at something else that's going to make more sense in the current environment. So let's have a look at the US 500 coming into one of the most important news announcements that we've seen really since last time, when all of this started going a little bit poorly, where we had that inflation read and it went really bad. So where are we? Well, we're on a trend line, kind of holding as best we can ahead of a big bit of news. Now, you can see a lower high, you can see a higher low. We're stuck kind of in a point here where it could go long or it could go short. And unfortunately, that doesn't really help us, but it's very common that we are in these levels ahead of these big bits of news, because the market is getting ready to make its decision. Now, what has historically been fairly strong support or a demand level has been around this 37.40 area. We've seen that pretty much find buyers and find demand so far. But if this level is broken and closed below, Ty, it kind of begins a few things. Firstly, we would break down the trend line. So we would make a new point. We would then also create one of our favorite kind of concepts, which is obviously a lightning bolt to the downside, being the peak, the trough, the lower peak, and the lower trough. And it could spell unfortunate, I guess you would say, pessimism coming into earnings, and then that would have that flow-on effect. So it's something that's important to note here in the charts. But yeah, this level here, it's very normal for us to be at a point of, I guess, testing both sides ahead of big news.
It is. It's amazing how the market actually does gravitate to these key levels when it is uncertain and it's expecting, and it doesn't bode well for a buy or a sell. Like Tom said, it's all about really letting it sort of stabilize and then picking the direction. And look, like Tom says, if the rot sets in and it does start to break down that trend line and we start to get that series of lower highs and lower lows, then what tends to happen is even reasonable earnings results don't actually help the market, because then it starts to gravitate to, once the rot sets in, it's very difficult to stop. But in saying that, though, people are always looking for a feel-good story. At the end of the day, you've got to remember too, and with the Fed increasing, decreasing, and doing all sorts of things, they're not trying to ruin the market, right? All they want is a stable market and a stable economy. So if they're not trying to trick us by saying, okay, we're going to go to 3.4, then we're going to go back to 2.7.
Serious thing.
Yeah, it's a serious thing. Their plan is to have, in their perfect world, the market stay stable, the economy stay stable. That's their job. Their job is to keep everything stable. They're not in there to ruin the market. They're not in there to boost the economy. Their job is to actually keep everything stable and at a place where we don't see big market crashes. That doesn't help anybody. So yeah, and that's why it changes. I mean, those numbers will change, month on month. And if if inflation does come under control and we don't see those rates aren't going to come down. They'll only come down if we see, everybody holding the tuna and holding the timber. If everything stabilizes, their idea of raising rates slowly is so we actually get a chance to catch up and the economy gets a chance to actually not fall into the recession that everybody seems to already be talking about, because their idea is actually to avoid that. But even if it happens, if it comes out of it faster than expected and the economy is actually going okay, they're not going to lower rates for the hell of it just because the yield says so. That's just what the anticipation is. So that will change. Don't take that for granted.
So here's the CPI numbers coming out for today's session. Obviously a big one. You can find the economic calendar on Pepperstone's website under economic calendar. Just search it in Google, Pepperstone economic calendar, it'll come up. And then we scroll through the next day and you'll see that we have Other information coming out into the markets, obviously a whole bunch of different info coming through. And then on the big one as well, we've got core retail sales coming out as well on the Friday. So this is going to be some of the big information that really is going to be super important to the lead into the earnings season. It might set the tone, and then we'll find out whether the earnings can back it up either way. When you're talking about earnings calendars, something like this is always good to have. And this gives you a bit of an idea of expectations. So let me just zoom in here so you can see some of these expectations. There we go. Hopefully now everybody can see it on the screen. And what it shows us here is some of the big calls for the next week. And Bank of America is, of course, coming out. And it's important that you know when this is going to happen. Expected revenue growth is 0.9%, revenue, earnings per share, all of it very close. Obviously tells you everything you need to know about this particular stock, and it tells you the release time, New York time here, 6:45 New York time. So if we scroll back, we get that kind of number. Now, why that's helpful is because when we go to these days and we know what's happening, we've got Bank of America, we've got Goldman Sachs, we've got Charles Schwab. Obviously, this is going to tell us really the beginning of the banks. Now, in many people's opinions, Tyrone, the beginning or the end of bad things and good things kind of starts with the banks, doesn't it? If the banks report well, it kind of shows a robust economy with no problems in the financial system and things are looking better, or things are at least looking stable. If banks show cracks, it's often a big problem because that can lead to, of course, systemic issues. And most importantly, if the banks underperform, it often can create a bit of a flow-on effect. So what are your thoughts about these big three coming in and the importance of Monday?
Yeah, it's a very, very big leading indicator. As much as people think that banks only, interest rates are going up, so banks are going to be making more money. It's actually not how it works. Banks, a healthy bank is generally equals a pretty reasonable economy, and I think that's why ideally they are used almost as a leading indicator or a lead into the earnings season. In that, if they start to perform well, it's a little bit like if one retail sector or a retail inner sector does well, the whole retail sector is expected to go well. Banks are almost like the market lead, aren't they, Tom? Like if the banks are going well, it really bodes well for the whole economy. And yes, it doesn't mean that every sector is going to be up, but as a whole, it's almost like it's a bit of a feel good story. It's a bit like waking up in Queensland on a sunny day and it's 25 degrees and sunny. Automatically, you've got a bit of an advantage. You wake up in a cold Melbourne winter and it's going to be 11 degrees as a high and you're feeling a little bit sad. Well, I certainly do. So it's a little bit the same. So all of a sudden there's a bit of a good feeling in the market because it's positive, right? That banks are an important, very, very important cog in the economic wheel and in the economic cycle. Nobody benefits from banks doing badly. Nobody. And I think that's why they're such a big, important leading indicator to how the earnings season's going to actually perform as a whole. Because if they're doing well, it's a little bit like if you've got like a football team and your fringe line players are playing really well and getting a lot of possessions, it bodes well for the whole team, doesn't it? It's a little bit like that. We need every player to be playing well, and banks are a very important part. It's the fringe players are the most important, Tom.
There you go. So Ty, I want to scroll over to the sectors here, and I want to understand kind of what's happening into this earnings season, the general trends coming in. So the first trend is, let's have a look at all the sectors, the big major ones. We've got here the energy sector, we've got here the utility sector, we've got clean energy, semiconductors, all of these areas. Now, certain people in the stream right now will be looking at certain ones. Now, often retail, we love tech, we love bio, we love those kind of areas. Have they been doing well or poorly this year? Well, simply put, only one sector has done okay this year, and it started turning pretty poorly recently, which has been energy. Metals, energy, utilities. They've been the ones. And when we understand coming in, we can actually look at these areas and say, okay, maybe we want to target in on certain stocks. What's been the general kind of 1 month move? Well, biotech's been doing very well with a lead into the earnings. Does that mean that they know something we don't know? Or is there some potential here of large moves? Well, bio has been the best performing in the 1 month. Healthcare has been another one. For anyone that's here in Australian stocks, like obviously healthcare has been doing okay as well in Australia. And then you've got consumer staples, and you've got a few other sectors like utilities, technology, etc. So for 1 month, it's kind of been going sideways. But there's been great performers and poor performers. If you were in energy for the last month, it's been 21.46% down. And coming into earnings, this is going to create a new movement. So depending on, let's say we have across the board, all banks do well. What might happen is we might see XLF start to take off and a new trend to begin, because the market doesn't just pack in price in one day. It's not like, oh, this earnings is great, let's go up 50%, which is where the market should be at, or anything like that. It tends to move up like maybe a few percent, 4 or 5%, and that can start a new trend that you might want to get onto. Now, Tyrone and I talk about trend as your friend quite a lot. It certainly is if you can find the correct one. So coming into earnings, it's also an opportunity that new trends could start. And once you see those new trends, a scalper, a day trader, a swing trader, everybody can get involved and potentially start looking for those. It's not so much predicting what happens before. It's then saying, okay, now that we have this information, as Tyrone and I say, more of a patience, react, don't predict mentality, is we can react to the information, find out the trend that's going in, look at the direction, maybe it breaks underneath, maybe it breaks out above, and then we can focus in on and saying, okay, well, at this point, maybe we're more interested then in scalping towards the long side until we reach certain numbers. If we break underneath, maybe we're interested in scalping more towards the short side because those trends start. That's what the opportunity in earnings is, at least the way I see it, from a beginner to an intermediate to an advanced.
Yeah, most definitely. And I think having the option on both sides, and that goes for every market, by the way, but this is just one example that we're talking about. But realistically, I think the stage is set for those key levels. I think that the line in the sand is drawn on the upside and the downside, really. And both of them produce really, really good trading opportunities, because I think that although people can be, very upset if the market's falling and they don't feel as good, a Melbourne winter isn't that bad if you're wearing a big polar fleece and you're going to go to the snow on Saturday. So there's always positive stories regardless. Like if you're looking at a negative market, let's just say we do break the 37.50. Is he trading over for the next 3 months? Well, it doesn't have to be, because if you're a scalper or a day trader or however you want to trade, if you're using CFDs, you can short as easily as you can go long. And sometimes the short actually happens a little bit faster. So, if we get to 37.45 and the rot sets in through this earnings season, you're going to find that it's probably going to gravitate like a magnet down to those lower, 3,500, which is what everyone's trying to predict. So, it gives you a really good opportunity to actually get involved on both sides. Don't be too depressed if it only goes one way. And that's it. All comes down to risk management. If you are going long and you're feeling a bit sad about it going down, look at potentially hedging some of your positions, or look at taking some shorting opportunities. The opportunities are both ways. It doesn't cost any more to short than it does long. And when you're trading the right instruments, when you're trading CFDs and when you're trading currencies or whatever it is that you're trading, the opportunity is both ways. And you don't want to have that mindset. And this is what Tom and I always say, that you don't want to have that fixed mindset that you're only ever going to trade long. Because you're going to miss out on a lot of good trading opportunities. You need to, as retail traders, we have the opportunity and the ability to change our minds on a dime. Realistically, something changes in the market dynamics, we can be going short today and going long tomorrow just like that, and we wouldn't even skip a beat. And it's really important to have that, so you don't have a preconceived bias that you can only trade in one direction, because if you do, you're limiting yourself to not only being able to only trade parts of the year, but really missing out on some really, really good opportunities. Don't think that shorting is a bad thing. Don't feel bad about it. I don't. Do you, Tom?
Just a little bit. No, I don't. I mean, maybe if I'm shorting something in particular, if I think it's you kind of feel bad when it's a small little company that started up. Then again,
we're talking when we're talking shorting. We're not saying let's kill Lehman Brothers here. We're talking about getting the indice to key levels, because guess what? The one thing that we have experienced time and time again is all good shorts lead to a very good long. Okay. And that's really what happens. Like now we say, okay, we have the opportunity to potentially short. Let's just say the market does go short and it does pull down to the 3,500. Well, guess what? Yeah, we're going to start getting some really, really good opportunities to start looking at long positions again. And then all of a sudden, we're going to get involved in a really nice trend up at some point. We don't know whether that's going to be in the next month or the next 6 months. But when it does start to trend up, we're going to be able to get involved in a good long trend really, really early because it's coming off a key level. So not only do we take advantage and benefit from the short market, but then we get to benefit even more from the market when it turns around. And I think that's where the real opportunity lies, because then you can really take advantage of big, strong trends that have got a long way to go. I think you've really got to be open-minded. I think that's probably the most important thing. You've got to enter season's earnings with an open mind that whichever way the market goes, have a plan. And I think when you've got a plan, it doesn't really matter which way it breaks, does it?
Yeah, that's right. When you have the plan, you have your key levels. It really matters not when it breaks. It's just that you know that is now plan instigated, and that's a good thing. We've got a great question coming in here from Shelley, and it's what do you do when the market isn't moving? I'm having a hard time sitting on my hands. Yes, the great dilemma that most traders have, and that's why I keep to the mantra, Ty: patience, react, don't predict, because if we can have the patience, you'll find your trading does improve. There's a few people out there in the chat that I can see that I know have improved by having patience. But the biggest thing, and we do a bit of training on this, is that I've found that as soon as you show people the way that markets move and the way that they set up positions, and you have basically schematics, that is replicatable plans, then you tend to have a lot more patience. It's having the plan. Tyrone really nailed it on the head there. Whether it goes up or whether it goes down, we have the plan. It's like chess. We're thinking everyone else might be playing checkers. I like to be playing chess, Ty. And I might not be the Queen's Gambit or whatever it's called. But one thing that we certainly do want to be doing is planning out the scenarios. And I spend most of my time thinking about the plan, thinking about the concept. And then ultimately, all you're doing, it's quite simple. You're setting alerts. If you have a plan that says, okay, we get past 38.80, let's just say, and that's a trigger for you to come in and have a look at the market, set an alert. If it gets past 38.80, it sends it to your phone, then you've got it. If you have a plan that gets past 37.40 or something like that, and you want to be coming into the market and looking for opportunity, do it. There's no real advantage of sitting in front of the charts all the time. No. You'll burn out. I know.
It's actually a disadvantage. We've done it. Yeah, it's a disadvantage. And really, it's something that you really want to try and avoid, because it gets you, then you start to get involved for the sake of being involved because you think you've invested a certain amount of time and you should be rewarded by some sort of action. That is not the case. It's a little bit like, no, I won't go into that. But it's look, what you need to do is you just need to make sure that if you do have a plan, the question you're going to ask yourself is, how many plans are going to actually kick in versus ones that don't? You might be surprised at how many plans actually don't actually even come to fruition. But does that mean that you've actually planned incorrectly? No, not always. It just means that, like sometimes the market just doesn't react in a way that you would expect. But the fact that you've had the patience and the discipline to actually wait for that plan, even though it didn't work out, guess what? You've saved yourself a trade. Yeah, you've saved yourself a loss. And that's where the discipline kicks in. That's where the patience kicks in, because when you see the market unfold the way you expected and a good plan comes together. Which movie was that? When I love it when a plan comes together. I can't even remember what that movie was. But it is a beautiful, beautiful thing. Yeah. It's a beautiful thing when a plan comes together. And that's what Tom's talking about, the replication of seeing something work out time and time and time again gives you the confidence and the patience. Because I think sometimes people get caught into a bit of a trap of thinking, I've set 10 plans, none of them have worked out. I haven't got in any trades. I must know what I'm doing. That is not the case when you actually have the right plans and you see them work out. You have the patience to actually believe in them and believe in the strategy, and eventually they will. You won't rush into a trade because you think you're just not getting any action. So it's all about those key words are very, very important.
So there's some good little comments coming in here from the chat, and that's why I brought up this screen. DJ AJ says cash is a position. Absolutely, cash is a position. Sometimes it is one of the best positions. Ultimately, cash has been okay into 2022 so far, even though cash was crap back in 21 and 2020. Yeah. Now cash is king. That's what they say. So the next thing here is Kim says, grade your trades and only take your better graded trade setup. So this is after you plan, review, and you keep a trade journal. Absolutely. It's about reflection. I always think of it as like a great hockey player versus a good hockey player. A good hockey player or a normal sports person is going to be looking at the puck, Ty. They're like, oh, I'm coming for you, puck. A great hockey player is looking well in front of the puck. They're looking at where the puck's going to be, not where the puck is right now. So they're already well ahead. And what that really means is they've got critical thought analysis. They have a clarity in their particular profession, just like most of you out there are really good at what you do. In trading, it's the same thing. It's not time. This is not a business where time in equals success. This is a business where discipline and well thought out planning equals success. Boring concept, unfortunately, very valid. And it took me a while to get there. It took Tyrone probably a while to get there. It's not something that comes just like this to us, because a lot of the market's there to hurt our psychology in some ways in terms of the up, down, and all the rounds. We have to have a clarity of what our plan is. Replication of whatever system you choose is super important.
Yeah. And we are very lucky, in the time that we are in right now, that we have so many things available to actually take away that boredom, take away that, isolation, if you like. When Thomas and I first started, we didn't have the communities and the technology that we've got now. I had Tom and a cat, and we used to just sit around with her own company, and it was not horrific, but by golly, you could see why you could make a lot of mistakes when you're in isolation like that. But we're in an environment now where there are trading communities, there are forums, there are all sorts of things. Like we've gone through half a dozen things tonight, and they're just the basics of how much information that you can get just basically on a bit of a search. But we would encourage you to definitely jump into communities. Like, they're really, really important. Pepperstone have amazing libraries in their YouTube channels to touch up. When you're bored and you think that you can't trade, go back and research, go back and learn. Cannot emphasize that enough. Jump into the YouTube channel that Pepperstone have got. We've got webinars dating back, I think, since 2015 in there, covering nearly every topic there is to cover. You can never, ever stop learning, and history repeats itself. It just does. Okay, so it's really, really important to keep educating yourself. Treat a flat market. The question we had before, it's hard to sit on your hands. Use that time to, educate yourself. Go study what happens in flat markets, and you'll be amazed at how you all of a sudden can, trade what looks like an untradeable market, because you've picked up some tips and tricks on what's happened in the past.
And it doesn't matter which stock you're looking at coming into this earnings season, Ty. It's one of those ones where it may be the best course of action to be patient. I know a lot of people don't want to hear this, but look at some of these markets. Let's have a look here. Look at Tesla. It's basically in some form of either could be distribution or could be accumulation. We have supports, we have resistances, and we have a middling ground. Either way, could be a break, could be a real opportunity moving forward. If we move over to something like an Apple, look familiar. We have supports, we have resistances, and we're somewhere around the middle. And no matter what real stock you look at, here's Google coming into a split soon. Where is it? Just hit a resistance. And again, it's in a consolidation. Now, if earnings turns out better and if the inflation number turns out better and everything looks great, where do we expect to go? Potentially, we have a bit of a rally. Doesn't mean the bear market's over. Doesn't mean everything's improved that much. But certainly opportunity will arise. That's why potentially the reaction coming into this earnings could be the better possibility than the prediction of what's going on. And I think that's what this market's telling us. And it's not maybe the news you want to hear, but unfortunately, it's the news of the reality of how we're seeing these markets. The markets themselves are partially confused. You've got huge amounts of bears, a little bit of bulls, and a lot of consolidation.
You've effectively got a zoo, and realistically, one of the lessons that we learned really, really early on, and it's an important lesson to be, I believe, to be truly successful at trading in the long run, is identifying that choosing not to trade a market that's untradeable is a trading strategy in itself. And when you grasp that and understand that watching and waiting is actually the key to success, not entering every single market that you see because you feel you need to. Professional traders don't trade every single day most of the time. There are some that make a living out of maybe scalping and having very, very high frequency trading strategies, but that's a different strategy. Okay, they're not actually looking for moves like this. But yeah, for the most part, day traders and swing traders, it doesn't mean they, just because it's termed a day trade or day trader, it doesn't mean they trade every day. I can tell you there are many days when you don't want to be anywhere near a position. And identifying those days is actually more important than identifying the days that you can trade, because you know what? Anyone can trade an uptrend and anyone can trade a downtrend. It's these markets that you need to be able to really identify where and when to actually enter and not enter, just as importantly, because like anybody can trade an uptrend, right? I mean, it's anyone can just jump in.
Yeah, that's right, Ty. And look, I think a lot of the opportunities, Pepperstone's a multifaceted broker with so many opportunities out there. Yes, we're coming into earnings, but one of the other plays that's going to be happening right now is probably going to be around cash, the US dollar. And depending on how this all plays out, there's probably going to be dramatic ramifications for the dollar, whether it's up in the current direction, which it has been doing, or whether it's down. We don't know yet, but the opportunity could arise in these markets. So I think a lot of the volatility will come into the currencies, Ty. I think you're going to see volatility through the S&P 500 indices, maybe a decision made, which is going to be fantastic for prolonged maybe trend there after that for a few days, if not a few weeks, as we see the story unfold. And what you're going to want to be checking out is the beats versus the misses. How many companies are beating, how many are missing? One thing never to fall into, any beginner out there, is to think that PE ratios are getting cheap just because you see them on a PE ratio at the moment. Remember, if markets are coming down, the earnings are probably also coming down. So therefore, they're adjusting PE ratios. That's very important. So it might look cheap on paper at this time, but once it's all adjusted, PE ratios can be very different. So just remember, there are always these little tips and tricks. You can always come and join us here on the Pepperstone channel. Make sure to subscribe, give it a like if you've enjoyed today's stream. If you have any questions, feel free to ask them now as well to both Tyrone and myself. Ty, do you have another comment you want to say about this earnings?
Yeah, look, I think we've pretty much covered. I just think this is probably not the earnings that we're always going to be used to. I think it's one we have to be extra careful in, and it doesn't mean that there's not going to be trading opportunities. It just means that we probably have to be a little bit more vigilant, that there's a little bit more going on than the normal standard earnings season. So definitely. I was just reading a comment where trading is the only place you can work 48 hours and actually lose more money. It's
a good meme, that one.
It is. Yeah. And I think everybody seems to be getting it too. And it's great. We're so lucky that, we've got an avid group of followers in the community. We've been doing this for a very long time now. And it's really good for Thomas and I to see people evolve with us and actually really take on board what we say and actually see them develop in their own trading journeys. And it's a beautiful thing to watch. It's almost like us putting together a plan, because Tom and I are very invested in seeing other people succeed, because we didn't have this when we were starting out. We had to recreate the wheel, so to speak. So
I just remember millions of pips and fat profit algo. All these other things. They were terrible.
So we almost feel privileged to be able to bring this to you, because we've experienced what I'm sure most of you have experienced at some point or are experiencing right now. And our aim is to actually stop you from making the mistakes that we made. We're by far from the perfect traders, especially when we were early on. We learned a lot. And now we're able to actually share that knowledge, and we really actually appreciate the opportunity to do that, because it really gives us a lot of satisfaction seeing people avoid the mistakes that we made. Because although we can laugh about them now, they weren't bloody funny at the time. I can tell you that.
No. I remember the good times and the bad times very well. But more importantly, if you ever do have a bad time, try to create that as a bit of a kind of like a memory that you remember, so that you never make that mistake again. It's something.
Don't forget it.
Shelley says here, true, my impatient cost me a lot. Well, let's see if we can remember that. I mean, no, don't worry. You're not alone. Most people have that problem. And the only way to overcome it is to realize it's there and then become more patient. I've trained some people recently on this. Terry M says, so much to absorb. Cheers, guys. Yeah, I think it was meant to be a beginner one, Ty. So I do apologize for this slightly advanced topic conversation about yielding before, but super cool concept. And if you ever want to look at forward yields, you can put in some of those codes into the Pepperstone, the trading view platform or something like that, and have a look at it, because it's kind of cool.
Most definitely. Also, don't ever forget that if you do have a topic that you'd like us to cover, please let Pepperstone know. We love to cover topics that come from the people. That's what we're about. We want to share, and we want to, really give you our experiences on the topics that really interest you. So, never be afraid to reach out to Pepperstone and say you'd love to hear more about this or that. And of course, always check out the content. Yeah, our good friend Chris Weston is putting out content basically every day. Pepperstone have got an amazing channel, and it's a great resource for all of the things that are happening on an everyday level. So don't ever be afraid to reach out to us or to Pepperstone. And we really want to bring you the content that's going to interest you and benefit you the most. So I think that pretty much wraps us up, Tom.
I was going to say, just on your comment about Chris, Ty, he's got a good one on Pepperstone channel. Check it out after this, the CPI one. If you're watching this before the CPI, I think he put some of the expectations in there. It's nice just to see the variance from the street, and he's grabbing that out of some pretty top end software. So that's very cool.
Yeah, Chris's resources are, basically probably better than anybody's in the country, and he really brings it to the people better than anybody. I believe he's just great at it. So definitely tap into his. And I think a lot of his videos are being tuned into 2 minutes now. Like he's doing like a 2-minute video every day, which is just it's probably the most valuable 2 minutes you'll hear on a daily level. Take the time to watch it, because he is very, very, very good at what he does. And even if you just pick up the odd bit here and there, it will be valuable. So thank you so much. We look forward to seeing you in a couple of weeks. We'll be well and truly inside of earnings season, so we might just have a very, very quick recap in a couple of weeks' time when we come to you from our next webinar, and we'll see how it's tracking. But thanks again, and trade safe. And I'm not sure if you're a rugby follower. I know it's the rugby tonight, and we've impeded on your match. So good luck to whatever team you are following.
All right. Thanks so much, guys. Good luck today. Hopefully inflation brings you the trade that you want. See you for now. Bye.
Good night.